Hi everyone, and welcome to ABG Investor Days. My name is Nikola Kilanowski, and I'm an equity research analyst here at ABG. With us today, we have the CEO of Midsona, Peter Åsberg. The idea is that he will present to us his company for about 20 minutes, and then we will have an opportunity for a brief Q&A for about 5 minutes. And with that said, the floor is yours, Peter.
Thank you so much, Nikolai, and thank you to the audience also. I will take you through the journey of Midsona, who we are, where we are, and where we're going. But I think we can linger on this first page for just a few seconds, because this is really a crash course in terms of what Midsona is. Midsona is all about healthy and sustainable food. So, food for both the people and the planet, and we reach the consumers via a number of strong brands. If you're Swedes, you will probably recognize some of the brands, and hopefully you're consumers yourself. Other brands are international brands that are iconic brands in their respective countries. I'll start by a little bit of an introduction, and I'll take you through basically the journey of Midsona for pretty much the last 10 years, because it also says quite a lot about the future for Midsona. Midsona was on pretty much a constant growth journey from about 2012 until the early 20s. This journey was driven by a number of very specific factors that still are in play in my mind. It's the overall interest for health and well-being, to eat both healthy and sustainable food. The market, and at that point in time in 2012, we were only a Nordic company. The market at that point in time was extremely fragmented. And we set out on a journey to consolidate that Nordic market by building our own brands, but also by acquiring good family companies. And I've said this before, but I say it again, it's half a joke, but there is a certain truth to it. I've spent a lot of time drinking coffee with owners of family companies, because that's usually how it started. We identified companies that we were interested in. We made contact. We met. The first meeting was also just a nice meeting often, because the owner said that we're not for sale. And we went home again, but we kept in contact. And then at some point in time, there was an opportunity because of a succession question, because the owners had taken the company to a certain level, and taking it to the next level would be much harder. And then it was quite natural to basically contact Midsona. And this is what you see here at the bottom, that year after year, we have acquired 1 or 2 companies basically, by that building a stronghold in the Nordic market. Another thing that we identified back in 2012 was the fact that a lot of the sales was done in specialty stores, so basically health food stores in the Nordic countries. Our conclusion was that if we want health and well-being to be a major factor in society, we have to offer the brands in the grocery trade, i.e. the big retailers like Inga, Coop and Aktier in Sweden and others in the other Nordic countries. So this is pretty much what we did, and we had a fantastic growth journey. Then in 2017, we concluded that we had a very good base in the Nordics, and we started to look at the rest of Europe. And what we saw was that the same factors were in play that we saw back in 2012 in the Nordics, i.e. fragmented markets, lots and lots of family companies, few strong brands. So we started a journey to establish a base in Europe. First by acquiring Davert in Germany as a platform acquisition, and then the French-Spanish company Alimentation Santé. So we started to do that. Then came the pandemic, and everything really changed. It meant that we had to focus on supplying. We had very good demand, fantastic years, especially 2020. It was a record year for us. Also 2021 was really, really strong for us. And we did not have the same focus on acquisitions in those years. Then the next phase is, this is basically from end 2020 up until end of last year. It has been a tough period for us. There is no way denying it. We have been very hard hit by cost inflation. We have addressed the underlying issues, but it has taken some time. So 2022 was a little bit of a lost year for us in terms of improving profitability. I would say that the basis for getting back on track, starting to increase profits again, starting to expand the business, is much, much better now at the beginning of 2023. But I will come back to that later in the presentation. In terms of our scope, we started in the Nordics, and Nordics is still our main hub. It stands for roughly 70% of the business. Germany, DACH countries, about 20% of the business, and Southern Europe, with France and Spain, about 10% of the business. And of course, we want to expand all those different divisions and geographies, but the main focus going forward is to strengthen our position in Europe. That still remains as true as it did a few years ago. And there is room and opportunity for this, as said. The Nordic market is, relatively speaking, consolidated, but out in Europe, it's still a very, very fragmented market. Lots of companies having difficulties right now, and I would say that we are relatively seen very strong in the market right now, and we therefore have good opportunity to expand the business. A little bit about our categories and our brands. In rough terms, about half of our portfolio is organic, so it's ekologiska produkter in Swedish. About 30% is conventional health foods, and 20% is consumer health products. Consumer health is our heritage. That's where we come from. So that is basically the vitamins and dietary supplements. It's a solely Nordic business. It's a good, solid business with good profit levels, but it's not where we put our main focus right now. Our main focus is to grow health foods and organic foods, and especially organic foods. And we have a very strong position in organic foods. We have strong and leading brands in all the markets we're present. You probably know Kung Markatta if you're from Sweden. We have the brand Urtekram, that is a strong brand in Denmark and Norway. Helios in Norway, Davert in Germany, Selnat and Happy Bio in Southern Europe. So we have a very strong portfolio in the organic segment. The brands are typically national. So what we are doing is that we're having the same products, but under different brand names in different markets. Then a number of health food brands. Friggs, a very strong brand in the Nordic countries that we took from Sweden, then to Finland and to Norway. And at some point in time, we will also take the brand to Denmark. I pretty much talked about this already, but this is our three operating segments. So our stronghold is the Nordics. It's also, although we had a tough year, we had at least a reasonable profit level in the Nordics. We had more challenges in North Europe and Southern Europe, to some extent due to the fact that we are subscale in those markets, and that's the main focus that we have going forward now, to increase our scale in the rest of Europe. Very shortly about our strategy and targets. We have said that we should become a European leader in healthy and sustainable food. Our mission is to bring healthy food that is good both for people and planet. So it's both a health aspect for people, but also a clear sustainability aspect. The way to do that is by creating leading brand in attractive segments. It's via streamlining our operations, and it's about selective acquisitions. Right now, I would say that our main focus is not acquisitions, but we will come back to that in due time. Financial targets. Considering the downturn that we saw in 2022, we are quite far away from them right now. But for sure, we are very focused on getting back on the growth track again. I think that will happen in 2024 rather than in 2023. This year is more about profit. Our main target right now is to restore our EBITDA margins. We will do that step by step. We have had quite a high gearing in the company, so this is something that we're currently looking at, and I would say that we will probably be lowering gearing in the future. And it is our ambition to get back to a situation where we can pay dividends again. The industry. I've already talked about this, but it's still a very fragmented industry. Here you see some of the bigger players in the industry in Europe. It's Ecotone, it's a French-Dutch company owned by private equity. Lenatur and Nutrition Santé, both French companies. Midsona and Heinz Celestial, which is a US-based company with quite a strong presence in Europe. So relatively speaking, we are a relatively large player in this market just because it's so fragmented. There are lots and lots of mid-sized companies. Here are some of the more well-known. We know a lot of those companies. We have been in contact with a lot of those companies. And if you go one page further, this slide is actually quite old, but it still holds true. We did a major analysis a few years ago to look at potential acquisition targets. We found almost 1,000 potential targets in Europe. And the thing is that nothing much has really changed in the last few years, because first came the pandemic. It meant that most companies were focused on their own business, also us. We did not do many acquisitions during this time period. And then came the cost inflation crisis. So in my mind, this is an industry that is ripe for consolidation. We want to play part in it, and we want to be one of the actors that are in the driver's seat making this consolidation happen. I would say that there is a lot of things going on in the market right now. I don't exaggerate if I say that I get calls or emails almost every day about companies that want us to buy them or want to start a cooperation. And this, I think, is a pretty strong sign of that there are a lot of the companies in the market, a lot of companies in the market that are in quite a difficult situation. And in that sense, we have a much stronger basis and foundation. So we want to be an active part in the consolidation of the market. There is a lot of discussion about consumers choosing cheaper alternatives when the wallet is a little bit thinner. Yes, we do have some of that effect, and we have seen some of that effect. But overall, I would still say that consumers are as interested as ever to eat healthy and sustainable food. I think that this is a macro trend. I think that this is a trend that will last. We see the increasing impact of climate change. People know, the society knows, that we need to eat more healthy and sustainable. It's a major part of fixing the climate issue that we have. Current status in the company. And we go to the next slide. I would say that we had a decent Q1 where we saw a lot of change, a lot of things moving in the right direction. It should be said that Q1 last year was not fantastic, but it was still decent. The real issues for us started in Q2 when we got the full impact of cost inflation from the war in Ukraine. Even considering that, we did grow sales slightly, and then we have still one discontinued quite big distribution contract that we have to deduct. We're quite happy about the sales development in that respect. EBITDA at about the same level as of last year, so that was also a step in the right direction because we had a number of quarters that we were quite negative. The gross margin was restored and even a little bit better than the same quarter last year, so up to 0.2 percentage points. And for the second quarter in a row, we had a very strong cash flow. We have been very focused on EBITDA and cash flow to get the business back on track again. So 2 strong cash flow quarters in a row, which is really, really great. The main thing that we worked on during last year, took some time, was to restore our margins. We were very hard hit by cost inflation. It was raw materials, transports, energy, pack materials, and so on and so forth. And this is quite a busy slide, but as you can see at the bottom, in quarter 2 last year, our gross profit margin was down 4.7 percentage points. It was minus 3.9 in quarter 3, minus 1.3 in quarter 4, and now the first quarter of 2023, we were up a little bit. So this was a sign that the measures taken to reduce cost internally, but also to push through price increases to the trade, has been successful. It should be said also that in quarter 1, we do not see the full effect of the price increases because many of them took place mid-quarter, say in February, and some even in March. So our expectation is, all else equal, that we should continue to improve our margins. We also see the first signs that commodity prices are actually coming down. You've probably read about this, that world market prices are starting to come down. We see some sign of this now. It's a little bit different in the organic industry because you don't have the same type of world market prices. You have to go back and renegotiate contracts by supplier, and that takes some time. But our aim is definitely to further improve margins and thereby get back to historical levels. My 20 minutes is soon coming to an end, so I'll talk a few minutes about the future also. And as said, I think that the platform that we have after a tough 2022 is much better now at the beginning of 2023. There are a few things that we will focus on now. First of all, we need to continue to develop our portfolio. Our conventional food brands have done very well, consumer health brands also. The main challenges has been in organic. The organic market has been down last year in pretty much all markets, and we have been going down together with the market. So putting a lot of effort into actually revamping our whole organic portfolio. I will come back and show a little bit about that later. We need to accelerate growth in mainland Europe. So in Germany, France, and Spain, because this is where we're still subscale, and this is where we had some margin issues really. We have put, to some extent, new organizations in place, a lot of good new people, very commercially focused, and they are starting to now work customer by customer, channel by channel, to actually increase our presence, because we have good brands, we have brands that consumers actually like. We just need to get them out in wider distribution, and a lot about this is to move them into the mass market or the grocery trade. We are streamlining our business, especially reducing complexity. I have an example of that. I will not talk so much about that right now. And we have said that this is a year where we're mainly focused on EBITDA and cash. So volume is not our main objective right now. Of course, we want to grow sales, but more important for us is to grow EBITDA and to maintain solid cash levels. And that brings me to my 2 examples. We have acquired a lot of companies over the years, and in terms of commercially and in terms of administrative, we have been very good at integrating them. When it comes to portfolio management, factory consolidation, there still is a lot to be done actually. I have to be honest and say that we do have a very complex portfolio. We have around 5,000 SKUs, 1,000 suppliers, and almost 100 brands in our portfolio. This is too much, I mean, clearly. And that's why I'm saying that the main focus for the rest of this year will be EBITDA and cash rather than volume. So we are starting now to really reduce complexity in the portfolio. We are trying to sell some part of the portfolio. We will discontinue some brands. We will cut out some SKUs, and we will significantly reduce our supplier base. And we have some good examples of that paying dividends already now, but even more so in the future, hopefully. Procurement, very important. Direct materials is about 60% of sales, and COGS around 75% of sales. So we're putting a lot more of emphasis in terms of how to source efficiently, how to pool our buying power better. And this is also something that we expect will pay dividends during this year and the years to come. Organic is something that a lot of consumers want to consume. But we have said that maybe organic is not enough anymore. So we have to also build more values around our organic portfolio. This is actually work in progress, so this has not hit the market yet, but we are right now in the midst of a major revamp of our organic brands in terms of how we communicate with a much more, I should say, much more edgy way of communicating them. And at least the first consumer tests that we have run are very promising. So, thank you for listening. We are getting back on track step by step. We will continue to work very hard on this during 2023, and we look forward to a brighter future for Midsona. By that, I open up for questions.
Thank you very much, Peter. Thank you for the presentation. Just a few questions from my end. You mentioned in the Q1 report that you released not too long ago that you aim to streamline the current product offering and perhaps discontinue some product lines. Could you perhaps let us know what geographies are relevant for potential discontinuations or perhaps divestments? Sorry.
Absolutely. I would say that the most complexity in our portfolio is in the Nordics, because that's where we have most brands, we have bought most companies. So I think a lot of the work will take place in the Nordics on the brand side. When it comes to SKUs, I would say it's all markets, but mainly Nordics and Germany, where we have the most complex portfolio. Suppliers, this is more about pooling suppliers. We are sourcing raw materials, the same raw materials from too many suppliers. So this goes across all divisions, I would say.
And I think if we go back a bit to the Q1 report, you managed to raise prices during one of the price modification windows in Q1, mid-February in Sweden. How well would you say that your price increases have been met by stakeholders?
I would say that the target that we set out to achieve, we have achieved, so we're very happy about that. Of course, there is always negotiations and discussions with our customers. But I would say that our price increases were very well founded. They were justified. So I would say that overall we succeeded very well in terms of implementing them.
Yeah. And you managed to improve free cash flow during the recent 2 quarters by improving working capital. Would you say that there is still some more work to be done on that front, or are we finished?
No, we will continue to work very hard on that. I should, however, say that Q2 is typically a quarter where we have some inventory build-up, because we're building up one for the summer seasons. We produce a lot before some of our factories close or half close for vacation period, and also we are starting to produce for the Christmas period actually now. So some build-up probably in Q2, but then gradually down again. So we aim to continue to drive inventory down and manage working capital very tightly. Cash flow is very important for us.
Yeah. And I know that margin improvements and efficiency gains is at the top of the management team's agenda right now. But as you mentioned, down the line, you have the opportunity to perform some strategic and selective M&A. How would you say that the market for M&A has changed if we look now compared to, say, 2 years ago?
It has changed quite a lot. I would say it's quite dramatic, actually. 2021 and also 2022, we were quite reluctant to do any M&A. Because what happened was that most companies had very good years in the pandemic, especially 2020 and to some extent 2021. So multiples were extremely high, and the sellers wanted to sell at projected earnings for 2023 and 2024 that were even higher. And we saw it ourselves that this is probably not sustainable, the margin levels that the industry is enjoying. So we were very reluctant to buy anything in this time period. Now, valuations has come down a lot. I would say that there are, as I said, companies knocking at our door pretty much every day, wanting us to buy them. So there are quite a few companies that are distressed, and relatively speaking, we are on the up. Our profits have stabilized. I think there is good hope that they will improve further. So I think that there is very good opportunity. That said, we still have quite a lot of work to do internally, and that will be our main focus for 2023. But we are starting to look at potential acquisitions, yes.
Excellent. Well, thank you very much for this, Peter. I'm afraid that we are out of time, but thank you, Peter, and thank you to everybody else who was listening in.
Thank you, and thank you to the audience. Thank you so much.